somewhere between $60 and $100 billion. That's the estimated value of the gold, silver, and jewels currently resting at the bottom of the oceans. It is a staggering figure, fueled by legendary discoveries like the Spanish galleons Nuestra Señora de Atocha and the San Jose. These wrecks alone held hundreds of millions in precious cargo. Getting to that cargo today looks very different than it used to. We have moved past scuba divers looking for clues in shallow reefs. Modern exploration requires deploying industrial-grade remotely operated vehicles, or ROVs, to depths that would crush a submarine. Yet, despite possessing the ultimate technology to reach the seafloor, investing in sunken treasure is a famously terrible financial bet. Commercial treasure hunting operations haven't reliably turned a single profit since the 1980s. The problem for these extraction companies isn't finding the gold. The problem is the jurisdictional abyss they fall into once they try to keep it. Down on the ocean floor, two legal frameworks collide. On one side is salvage law, which traditionally rewards those who risk their lives and capital to rescue vessels in distress. On the other side are UNESCO cultural heritage laws, which protect these wrecks as historical artifacts belonging to their nations of origin. The company Odyssey Marine Exploration learned this the hard way. They located an estimated $600 million in coins off the coast of Gibraltar, only to have the Spanish government successfully sue and seize all 17 tons of it. When you combine decades-long court battles with massive insurance overhead and the constant threat of bad actors absconding with the funds, the business model collapses. Facing inevitable financial ruin, these tech-heavy exploration fleets have had to adapt. To survive, they are steering their massive underwater assets away from historic shipwrecks and toward a new, seemingly safer, and much larger industrial target. That target is polymetallic nodules. These are dark potato-sized rocks scattered across the abyssal plains of the ocean floor. They take tens of millions of years to form, accumulating metals layer by microscopic layer. Today, they are packed with the exact critical minerals, like cobalt and nickel, required to build batteries for the global energy transition. Mining companies are aggressively pitching the extraction of these nodules to governments and investors as the eco-friendly alternative to conventional land-based mining. But this green narrative is an illusion. We are trading localized legal disputes over 18th century galleons for a mechanism of global ecological destruction. When we measure environmental damage on land, we typically think in two dimensions, total area in square kilometers. But the ocean requires us to think in 4 dimensions. We have to account for the immense volume of the water column and the geologic time it takes for these habitats to recover. This chart illustrates the scale. Terrestrial mining for energy transition minerals impacts roughly 1 to 10 million cubic kilometers of the biosphere. Compare that to the projected impact of deep-sea nodule mining. That operation would impact an estimated 25 to 75 million cubic kilometers. That upper estimate is a volume larger than all the fresh water in the entire world, including every glacier and snowcap. Just as historic wrecks degrade into toxic hazards requiring complex removal, deep-sea extraction unleashes massive sediment plumes and noise pollution. Because water carries this disruption for miles, it guarantees permanent habitat destruction across entire ocean basins. To mitigate the resulting environmental outrage, mining companies and regulators have proposed a solution: post-mining ecosystem restoration. The primary idea is manufacturing artificial clay nodules and dropping them back to the seabed. The math behind this proposal is staggering. Current estimates price this artificial nodule restoration at $5.3 to $5.7 million per square kilometer. When you map that expense onto a standard deep-sea mining company's balance sheet, factoring in their normal operating expenses, the numbers completely break down. Actually paying for this restoration would instantly drop a mining company's profit margin to -83%.